Good afternoon, everybody. We'll wait for Josh to get off the phone. I said we'll wait for Josh to get off the phone. No, good afternoon. How's everybody doing today? Good. This is supposed to be a lunch and learn. I only see a few people who brought lunches, so hopefully you're all going to learn something. We're on diets, yes. All righty, so last few folks checking in and finding their seats. We're going to get started on the basics of like-kind exchanges and 1031s. So I'm an attorney. My name is Sam Saad. So since I'm an attorney, we're going to start off with a disclaimer. Everything I'm telling you is probably correct, but if I'm wrong, you cannot sue me. No, it's correct, but this is not legal advice, so if you have individual questions, we can go over those later. Speaking of questions, if you have any questions, raise your hand. We are live streaming, so I will repeat the question and then attempt to answer it. But during the presentation, as questions come up, feel free to interrupt and raise your hand. A little bit about my office. Been doing this since 2007 on my own. I've actually been an attorney for 16 years. We are a small business and real estate firm, and work really hard for our customers to give them good advice at a decent price. This is me. I'm on the Legal Resources Committee. Work a lot with NABOR and with you all. This presentation is part of the Legal Resources Committee's presentation series for Lunch and Learns. I'm a recovering politician, so if you hear Trump jokes, I apologize in advance. Today, we're going to talk a little bit about 1031 terms. We're going to do a step-by-step through the process. We'll talk a little bit about who the exchanger is, who can be a qualified intermediary. Prior to the Trump tax cuts, actually, I used to give a lot of tax advice, but so much has changed since then, and I focus my practice so much more specializing in real estate now that I do not give tax advice. So I will talk briefly about taxes, but refer you to CPAs who are maintaining their credentials if you want difficult tax advice on 1031s. So what are we going to talk about today? What's a like-kind exchange? What's a reverse exchange? What's a Starker exchange? These are all terms for what we're going to talk about today. I'll tell you, we're not going to get into the details of a reverse exchange because reverse exchanges are really just two forward exchanges. But where does 1031 come from? What does that even mean? Well, it's 26 U.S.C. 1031. It's the tax code section that gives taxpayers the right to avoid paying capital gains tax when they do a like-kind exchange. This is cut right from the section. This is 1031A1. No gain or loss shall be recognized on the exchange of real property held for productive use in trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in trade or business or for investment. So basically what we're going to do for the next 50 minutes or so is unpack this definition. Now, immediately, I want you to notice that it says the exchange of real property. This is new language. So for some of you that have done 1031s in the past, perhaps with non-real estate transactions, you cannot do those anymore. The law changed with the Tax Cuts and Jobs Act, and 1031s are only available to real property. And we'll talk about that in a little bit more detail, but generally, any U.S. real estate can be traded for any U.S. real estate, and we'll get into that. Okay, so let's start off with some terms. I want you all to understand who we're talking about and what we're talking about. So the most important party in the process is the taxpayer, the exchanger. They're the property owner who are seeking to defer capital gains, recapture, or other income by doing an exchange. They're your customer. That's who you are bringing to the table for the 1031. So a forward exchange, this is the most common exchange. And this is what we're going to be talking about today, but this is where we get rid of relinquished property and replace it with replacement property. And of course, as I said earlier, a like-kind property is generally all real property located within the United States can be exchanged for other real property as long as it's held for investment or business purposes. Okay, the qualified intermediary, for purposes of our conversation here today, that's me. The qualified intermediary is the person or entity that facilitates the exchange for the exchanger. Now, throughout this presentation, what I've done to make definitions easier, I've just used the word exchanger, but you can think customer or taxpayer. But for simplicity's sake, I'm calling this our customer the exchanger. And sometimes they're an exchange facilitator, an exchange accommodator, but in the tax code, it's qualified intermediary. And of course, real property, we all know that because we're realtors. Real property is the land, the fixtures attached to the land. It is not personal property. And as I just said, the law changed. You cannot do exchanges with personal property. So the next two most important definitions that you're going to hear today are the relinquished property and the replacement property. The relinquished property is the old one that we are selling. The replacement is the new one that we are buying. So we'll keep going back and forth about those. Okay. Next up is the exchange period. This is the time period in which the exchange must occur. It's 180 days from the date of sale or until the tax return. If the tax return is due earlier and not on extension, then it's the date when the taxpayer or exchanger's tax return is due. You can get an extension up to 180 days. So that's a really good, she asked, can you get an extension? So the operative date typically for your individual taxpayer is October 17th, I'm pretty sure that's right. If your exchange occurs after that and you need the full 180 days, you're going to go on, your taxpayer is going to go on extension to get their exchange done. Okay, next up is the identification period. This is the 45 days after the date of closing of the relinquished property to identify the replacement property. And we're going to get into the details of how to do a proper identification. It can get pretty complicated. But it's 45 days. That's a hard 45 days. There are no extensions for that either. Okay. Next up is your adjusted basis. So this is the amount paid for, I missed a word in here, the relinquished property, taking into consideration the added value for capital improvements decreased by the amount of depreciation taken or allowable. I said I don't give tax advice, but one thing I can say to you is, if your customer is not taking depreciation on their relinquished property, they should have been, if it's held for productive use for trade or business or for investment. So they're going to have an issue there. They got to get with their accountant right away. Next up, realized gain is the amount of realized from the sale of the property. It's your gross sales price minus your closing costs minus your adjusted basis. And then, of course, the recognized gain is the gain that's subject to tax. And that's if there was no 1031 exchange. Okay, boot. That's the fair market value of any non-qualified property. That's the money, the cash that the exchanger gets out of the exchange that have to pay taxes on. That's what we're trying to avoid in an exchange is boot. Okay, then there's constructive receipt. This is very bad. If your exchanger has constructive receipt, either because they have actual receipt or they control the exchange funds, they break the exchange. So you don't want receipt or constructive receipt of exchange funds until the exchange is over. Otherwise, you've just wasted your time. Okay, these next few definitions, the exchange, accommodation, title holder, the improvement exchange, the reverse exchange, I put them in here for your edification. They relate to reverses, so we're going to skip over those. Okay, let's talk about the rules of the exchange. Before I get to this, anybody have any questions on the definitions, on the terms we're going to be talking about today?
On investment property, especially commercial warehouses, there's equipment, forklifts, computers, all that, which is not included in real estate, would that be considered food?
The question is, say you're doing a warehouse property and you've got forklifts, computers, other equipment, not fixtures, not trade fixtures, not attached to the property, and it's part of the sale. Is that considered boot? The short, simple answer is absolutely yes. Those items, particularly under the new rules, would not be included in the exchange, and the seller exchanger would pay taxes on the gain on the sale of that property. And if it's all equipment, it's probably depreciated, so there's going to be gain. Okay. So first up, the property being sold and the property being acquired. So the replacement and the relinquished properties must both be held for investment purposes. Right away, someone had already asked me this morning, can a homestead property be held 1031? No, it cannot. By virtue of the rules of the homestead rules, you can't hold that property for investment because you have to live there. So what does it mean held for investment purposes? You could buy property and hold. You could buy and hold it for appreciation. You could hold it for rent. You could use it in your business, but it cannot be personally held property. Next, the exchanger must use the services. Oh, sorry.
On number one, what is the minimum time? I know there's not an amount. What's the minimum time that a property can be held in a 1031?
The question is, what's the minimum time a property can be held in 1031? We're going to get into that in greater detail, but it really just depends on who the exchanger and who the buyer and seller are. There's a related party rule that I have a slide on, and that minimum is 2 years, but there's cases that shows as short as 4 months. So you can flip property in 1031s if you do it correctly. If it was determined that you held the property principally like a fix and flip, and you held it for just like 3 months or 2 months, probably couldn't do the 1031 out of it because it looked more like inventory. I saw a question back here. The question is, can you buy a second home, claim to be holding it for appreciation, not take depreciation on it, and then flip it in an exchange? Probably not. Because if you're not taking depreciation on it, if you're not renting it out, and you're simply holding it for its appreciable value, you'd have to prove somehow that it was investment property. One of the big issues that I can see is if you fill out a loan application and you sign all your loan documents, one of the documents that you'll sign at closing is your use affidavit. If you've checked second home and not investment property, then you've just signed an affidavit swearing under oath that it's a second home and not investment property, because investment property is the third choice on the form. So it just depends on the full characteristics of the transaction. If you're the only one that goes there and you don't rent it out, another issue, looks like you're using it for personal use. And then depreciation, like I said on the earlier slide, it's taken or allowed to be taken. You would have to account for that depreciation in your 1031 exchange anyways. So you're going to get nipped for taxes regardless. So it can get pretty complicated pretty quickly. Okay, so you have to use the services of a qualified intermediary, trust, or qualified escrow to handle the account, to handle the transaction. The only exception is the straight up swap where A and B swap properties of equal value. Otherwise, the money must flow through the qualified intermediary, the QI. Okay, and then we said this already. Number 3, the exchanger cannot actually or constructively receive the proceeds or the sale will be disqualified. Real simple, and I get this question all the time when I'm acting as QI. No, you can't have the money. You can't touch it, you can't invest it, you can't look at it. It goes into my trust account and sits there for either 45 days until closing or 180 days, depending on the situation. And then number 4, you must have a written exchange agreement prior to the sale of the relinquished property. You must have that written agreement in place. It does. I have a 12-page agreement, and it covers all the scenarios. If you're doing this with your friends, which you really should not do, you don't need such a complicated agreement, but you must have somebody with a written agreement acting as your QI. You must have an exchange agreement in place. Yes, ma'am. Yeah. Yeah. The question is, I must use my exchange proceeds to purchase the replacement property. Can I then go refi and strip the equity out of it? Yes, you can. So she's thinking over here, she's getting ready to do some investing. Everybody with a good commercial listing, go talk to this lady. Okay. So number 5, the exchanger must identify potential properties by legal description, property ID, and address when available. That's going to be the replacement property, and you must do so within 45 days following the close of escrow on the sale of the relinquished property. And the deadline is 11:59 p.m. on the 45th day. And that doesn't matter if that's Christmas. So that's a big deal. People say, is business days? No. 45 calendar days, Christmas evening, I must have that piece of paper. Yes, ma'am. No, signed. Closed deal. Yeah.
I didn't hear a question, but you identify this property.
Yeah.
45 days.
Identify within 45.
Now, you're coming to me, the 1031, I have the listing.
Okay.
At this point, does your customer have to have a contract that identifies this property?
No. Okay, that's a good question. So the question is, do you have to have a contract identifying the replacement property within 45 days? No, you do not. What happens is the exchanger must identify up to 3, but there are other rules we're going to go over. It could be more than 3. Identify the replacement property in writing to the exchanger. So when I do the exchange, there are a number of documents that go into it. One of them is the 45-day notice that they have to fill out the PID, the legal, and the address, and sign it and fax it to me. You don't even have to know as the listing agent that your property is on the list. We might be coming to you the next day afterwards to make that offer and hope that we can get an accepted offer and close within 180 days.
But you as the exchanger don't necessarily make the offer.
I have nothing as the exchanger. I'm sorry. Yes, the exchanger or the exchanger's agent will make the offer. As the QI, I do nothing but hold the money. Yeah. So the question was, do I as the QI, the qualified intermediary, I don't do anything but hold the money. I cannot give tax advice. I cannot give legal advice. I simply act as the escrow. Yes, sir.
I send you a list of 3 properties, and after that we fail to secure contracts against them.
So the question is, I send you a list of 3 properties. I've done it within my 45 days, and then I fail to close. We're going to talk about that in a little more detail, but the short answer is the exchange busts. Your customer, your exchanger gets their money back, and they pay taxes. Okay.
Are you able to do out-of-state properties?
It's any U.S. property. The question is, can you do out-of-state properties? Any U.S. property generally will qualify for any U.S. property. So you get the duplex in Golden Gate, we can flip for the warehouse in Anaheim. It just depends on, it's just got to be like kind and generally any U.S. real property. Okay, number 7. The exchanger must complete the acquisition. That's the close. They must close on one or more of the identified properties within 180 days from the sale of the relinquished property, again, or the due date of their tax return, including any time for extensions. So I want to be super clear about this because I get this question in my exchanges all the time. I identify on day 45 of the exchange how many days do I have left to close. I've heard it from some people, 135 days. It's not 180 days from the day you identify. It's 180 days from the day you close on the relinquished property. Don't make that mistake and schedule your closing past the 180th day or when the tax return is due. So as we get into the end of the year, again, you're doing these closings, your customers are coming to you, they're saying, I want to do an exchange. It's past, I'm pretty sure it's October 17th. Make sure that they have spoken. We're going to get into this, step one of the exchange. Make sure they've spoken to their tax advisor and they can get an extension on their tax return. Yes, ma'am.
Can you do more than three? Identify more than three?
The question is, can I identify more than three? That is a very complicated question that I'm going to answer. I've got a couple of slides on that, so hold that one. I will come back to that. But the answer is yes. Okay, let's go step by step. Oh, whoops, I forgot to change the slide. Step by step through the process. Step one, call your attorney or tax advisor. Remember I said for purposes of today, I'm the QI, not the tax advisor or the legal advisor. Get with your accountant, do the disposition analysis, get with your attorney, understand how a 1031 works. As the QI, as the qualified intermediary, I will happily sit down with your customer and explain the 1031 process. I'll show them these slides, walk them through the whole deal. But when they start asking those detailed questions about how much taxes am I saving, should I be doing this, I can't answer those questions and give legal advice, so I disqualify myself as the QI. So get with your tax attorney or your CPA right away when you're ready to get started. Step two, call the qualified intermediary. Get the exchange process set up and make sure you understand all the documents, the assignments, what's going to be happening in the exchange process. We have two documents that the exchanger, the customer signs. They're going to sign an engagement letter where they agree to pay the fee, and then they're going to sign the exchange contract where I agree to hold the proceeds of the relinquished property and transmit them into the closing of the replacement property. And again, before closing, don't call me the day after you closed on your relinquished property and say, I want to set up an exchange. You've already taken receipt of the funds, even if they're still at the title company. You have to have this set up and in place before closing. Yes, ma'am.
Let's go to the exchanger and the agents.
Okay.
Identify three properties.
Okay.
Now, then we have the amount of time, 180 less to put a contract in.
To close, not to put a contract, to close.
Okay, there's my thing. Between putting a contract on and closing, where does everything lie in the fact that the exchanger is going to have the normal inspections, the
Yep.
testing, so on and so forth? So where does everybody play their part in this? In other words,
So the question is, what is the role of everyone while the exchange is going on? You all have the same role. You are the realtor, you are the broker, you are facilitating two transactions for your exchanger. You're selling their relinquished property, you're going to go through the whole process, you're going to get with your title company, you're going to get with your closing attorney, you're going to get the whole 9 yards for a real estate closing. The only difference is your seller doesn't get any money. The HUD, done correctly, should read zero proceeds at the bottom of the page to the seller. There should be a line up in the section above that shows all of the proceeds being paid to the QI, me, the qualified intermediary. Then I put it in my trust account, and then you, as the realtor, take your exchanger out, remind them that they have 45 days to identify the properties, and then you get a contract, and now you are on the buy side. Again, call your county, you pick your title company, You go, you do your closing, you get everything ready to go for closing. Typically, you're going to trade up, which means that you're going to be spending more money than when you got on the sale of your relinquished property. Now your exchanger is your buyer. He's going to wire his money into closing. The title company, the closing attorney is going to call me and say, okay, we're ready. Send in the QI funds the day before closing. I'm going to wire the funds into the title company. And then they're going to have a closing. And the exchanger is going to own the new property. The accountant will do all of the paperwork in the for the tax return at the end of the year to show the 1031 and how the depreciation all is not recaptured but put onto the new property, and everyone goes about their way. So for you as the realtor, you're doing 2 closings. That's your role. Identify. Know that you have to identify within 45 days, and when you're putting your contract together, know you have to close within 180 days. So you're looking out for how long your due diligence period is. So your roles don't really change. Yes?
They identify, they close on the contract, they go through all the inspections, and it just totally doesn't pass.
If the question is what happens if you have identified and you are going through your inspection process and then you don't want the property, hanging on to that question, we're going to get into what happens if you bust. You'll bust the exchange. Yes, sir.
What steps should someone take to make sure your QI is qualified?
That's a great question. How do you know if your QI is qualified and solvent? Well, the rules are anybody but a related party or an advisor who's given advice in the last 2 years really can act as your QI. But the short answer is make sure they've got E&O insurance. Just make sure that they're covered. So if they lose the money for whatever reason, you get insurance settlement. That's really, unless you go with Uncle Bob and then he takes off to Switzerland with the money, the chances of there being a problem with the QI are usually pretty slim. Like if you use a regular QI company, like I have an LLC set up that I run my qualified intermediaries through. I put a brochure on there, but the money just sits in the bank and doesn't go anywhere. So as long as they're an honest person, I guess, is the answer. Yes, ma'am.
Can a foreign investor do 1031?
No. The question is, can a foreign investor 1031? You cannot.
Question, a customer called me last week and said he's got some properties that are going to be closing soon, and he's thinking about doing a 1031, and I sent him some listings. Wow. I don't know if you know, but he only has 180 days from the day one of those closings happen. So,
It would be, the question is, should I send my customer listings when they call? Yeah, send them the listings, but just make sure, again, that you control those deadlines. Tell him, from your sale date, you got 45 days to identify and 180 days to close. So I'm going to send you a bunch of listings. You're going to have to pick some, and we're going to go through here in a minute.
basically, from the day he closes, he has 180 days to close on the new property.
Correct.
It's not 45 an additional 180.
Right, exactly, yeah. Don't get confused by this. It's 45 days to identify from the closing date and 180 days to close from the closing date from the relinquished property. Yes, ma'am. Day after. Yeah, so if you close on Monday, day 1 is Tuesday. Yes, sir.
Said if you're in a QI, you can't give legal advice to the people. So we have to have 2 lawyers to do this, or?
Well, I don't act as an attorney in the transaction when I'm the QI. So yes, if you want me and Naples Qualified Intermediaries to be your QI, they may need another attorney if they have legal questions, if they're like to negotiate the contracts on the purchase. Typically in commercial deals, you would have an attorney draft a contract. You wouldn't use a NABOR standard form for a commercial deal, so they would have an attorney that would draft the contract. And then again, at the closing, the money would come to my trust account, and then I would wire it out. If you could have up to 3 attorneys on their side if they had another attorney doing the closing. So, yes, ma'am. Trust. The question is, what about properties held in a trust? If it's investment property and the trust is a taxpayer, then the trust could be an exchanger. So you just have to look at the situation.
What about new construction? So new construction may have their own
Well, the question is new construction, you still need an attorney. If you're buying new construction as the replacement property, and the new, as long as it's held for investment, then the replacement property, the owner of the construction company, the developer probably has their own title company. Yeah, you just use a title company for the closing. You don't. It's never in Florida necessary to have an attorney. It's just advised. Buy an attorney. Yes, sir. I would have to look at that. I'm pretty sure the question is if you had a U.S.-based LLC that had some foreign investors, could you still do the 1031? I have to look at the qualification rules. I am not certain about that. But I put my card on your desk there. Send me an email with that, and I'll respond. That's a good question. If you've got, because I know, like for example, under FERPTA, you can have U.S.-based companies that might still be foreign. It's as defined by that section of the code. Again, I know there's a lot of talk about opportunity zones, but everything I've been reading says be careful. Okay, let's get back to the steps. Sorry, step 3, get your contract for your relinquished property. So you have to enter into an assignable contract to sell the relinquished property. So the NABOR forms and most commercial forms, they specify whether the contract is assignable. FARBAR has a checkbox. NABOR is freely assignable. And you have to execute the contract with the exchanger's name. So you just put the seller just like you would for any other deal. Copy the name off the deed. You don't need to put the 1031 on the contract. And you want language recognizing the exchange in the contract. So luckily, NABOR provides that. So does FARBAR, but this is NABOR. But the NABOR contract already has the exchange language in it. I get so many contracts where the realtor has written in some language about how the contract is assignable for the 1031 exchange, and it's wrong. You don't need to do that with the NABOR or the FARBAR forms. And you don't want to practice law without a license, so if you do feel the need to beef up this language, get with your closing attorney. Okay. Yes?
What happens if the relinquished property is in a different state and you want to buy a property here in Florida?
So the question is, what happens if the relinquished property is in a different state and you want to buy a property here in Florida? That happens all the time. So your Florida realtors, hopefully there's a referral arrangement that you can work out. They're selling a piece of property up in Michigan. They're gonna flip it into a Florida property, and you're gonna be the agent for the Florida deal. Again, your role is the same. You go through the purchase. They're your buyer. Go through the purchase process. The only difference is when they get like a proof of funds. Sometimes if it's a larger property, the exchanger will provide a proof of funds to say, yes, Bob Smith is doing an exchange with me. I'm holding $1 million in escrow. Here's my letter. So that's one small difference, but the process is exactly the same for you as the realtor. Just you don't need to worry about modifying the contract or any of those things because, again, the language is already in there. Yes, ma'am.
In that same scenario, suppose the relinquished property in the other state, they're doing it without a realtor being involved.
If they're selling without a realtor in the other state, they still can't touch the proceeds of the sale. It's got to go into the QI, the qualified intermediary, and then the qualified intermediary will transmit the money to your closing agent for closing.
Agent on a purchase of the new property here in Florida, should we be in contact with their attorney or something to make sure that the language is there on the selling side?
I see where you're going. Okay, so the question is, as the person who's dealing with the purchase of the replacement property in Florida, should you be involved in the sale of the relinquished property? The answer is probably no, because you're not a realtor in that state, unless you are. you're not a realtor in that state, you're not an attorney in that state, they need to deal with those people separately for the sale of the relinquished. You might mention it to them, hey, you're doing an exchange, make sure that you can assign your contract, but no, you wouldn't want to be involved in that because you're not licensed to do that.
Because if they don't make that right move on that side.
Yes, if they call you up and say, hey, I want to do a 1031 exchange, one of your first questions after you get their name and how they're doing is, who is your qualified intermediary? What's a qualified intermediary? Then now you know that they read something on the internet and you're going to have to educate them a little bit about 1031s, send them the slide presentation. Okay. Other questions as we go through this process? I want to make sure that you guys fully understand all this so that we, yes, sir.
Would a REIT or fractional ownership of commercial property qualify for the 1031?
Those are two separate questions. Would a REIT or fractional ownership qualify for 1031? REIT, no, because you're holding a personal interest. It could, on the fractional ownership, it depends how you hold it. You have to be, the exchanger has to be the taxpayer that pays, that picks up the depreciation on the relinquished and flips it into the replacement. So if you guys are like they used to do TICs. Some of you older realtors might remember tenants in common agreements. If you hold a fractional interest in the real estate itself, like you're on the deed with 10 other people, yes, you can flip those in a 1031. If you are a partner in a partnership that holds title to real estate, you have to do a drop and swap, and I have a slide on that. Okay. Step 4, close on the relinquished property. We got to sell the relinquished property. So there's an assignment, I forgot to mention in step 3. So the taxpayer exchanger signs and assigns their sales contract to the QI, then they deed the property directly to their buyer in the closing. And then again, the proceeds of the exchange go directly to the QI. They do not go through the exchanger. Step 5, identification period. Okay, so you've already asked all the questions on this, so I'll just go through this briefly. 45 days begins. It's a hard date. There are no extensions. You must identify within 45 days. And the 180-day exchange period begins. You must close within 180 days of the sale of the relinquished property, or you must close right before you file your tax return, but you can extend your tax return. Okay. Note, I put a note in here. This question was asked and answered, so I'll just read this briefly. During the exchange period, the exchanger may not have actual or constructive receipt of the proceeds. Pledging, borrowing, otherwise hypothecating the exchange proceeds is constructive receipt. You can't put the money in the QI and then sign a note and borrow the money from the QI. The money has to sit in the account, and it's not like I'm earning interest. It's a zero interest account. But it has to sit there and wait for the exchange period to be over, either because you failed to identify or 180 days if you fail to close. Say again? Yes. If the question is, can you use that money for deposit? If you have identified, if you close on the relinquished and you identify the replacement, the QI can send money from the exchange in for the deposit on the replacement. So they can transmit the deposit to the escrow company. All right, so step 6, identify the replacement property. By midnight on the 45th day, you have 3 methods for identification. Yes, James. Oh, whoops. Thank you. I should give this to you. Yeah. All right, 3 methods for identification. You must identify, again, by address, PID, and legal description. And what you do, basically, is you go to the appraiser's website and just clip the cut and paste the short legal and stick it on the 45-day form. And the goal is to be totally unambiguous. So you can't just say, I'm going to buy vacant land in Collier County. No, it's got to be unambiguous as to the parcel of property that's going to be purchased. All right, so let's talk. I know you all had questions about this. How do we identify? So by far, 99.999% of the time, you're going to follow the 3 property rule. You can identify any 3 properties that you want, and then you must close on at least one of them. You don't have to worry about fair market value. You don't have to think about anything other than getting the 3 properties, then you must close on at least one of them. If you don't close on one of them, the exchange is busted, boot, you pay taxes. There used to be a rule that you would put them in order. I'm going to go after this one, then if that deal falls through, I'm going to go after the second one. You don't have to do that anymore. Just any 3 properties. Identify your 3 properties and then close on at least one of them. You can close on all 3, but you must close on at least one of them. Questions about the 3 property rule? Oh, yeah.
In identifying the 3, I'm assuming you could identify one on day 1 after the exchange, and the third one you could do right up to day 45.
Correct.
So inspection takes place, you wash one of your identified properties, one you already have 3, you could add another.
Correct. The question is, do I have to identify all 3 at once, or can I go do 1, do my inspections, it falls apart, do 2, inspections, falls apart, do 3. As long as you can get all that done and get me up to 3 properties by midnight on the 45th day, you're good to go. Yes, ma'am.
Let's say within the first 20 days or 45 days, all 3 deals have fallen apart for whatever reason. Are you able to even go after other properties within that 45 days?
The question is, if I've identified 3 properties, I do my diligence on all 3 properties, and they all fall apart, and I'm only at day 20, can I come back and identify 3 more properties? Yes, you can. I saw a question here.
That's kind of my question is, if I've got 3 properties and one of my 3 properties for some reason is no longer available, I can always replace it with another one.
In the 45 days.
In that 45 days.
Yes, yes. So the question is, what can you do within the 45 days? It's not like you identify 3 and then that's it. It's the 45 days is the more important issue. Yes, ma'am.
Put raw land in it with the intent to build the lake property.
Can you put raw land down as one of your 3 with the intent to build? Yes, you can. You can use the exchange money to purchase the raw land. You cannot use the exchange money for construction. There are ways to do that. You recall one of the definitions up there was a construction exchange. It's basically a reverse exchange where you have to buy the raw land first, borrow the money, build the project, sell the relinquished property, and then use that money to pay off the loan and close on the replacement property. It's a reverse exchange. Very complicated, a lot of paperwork, great fees. No. We're here to learn today. All right, the 200% rule. That is the 0.0001 of you will use this 200% rule. You can identify up to 200% of the value in any number of properties. So you sell the $1 million property as your replacement, and your guy's got a lot of money. He's thinking about making a big splash. His last name's Hoffman, and he wants to come down to Naples and buy a bunch of investment property. You can identify up to $2 million of those $2 million worth of property, and you close on at least one of them. But the question is, how do we know the value? What if you accidentally identified $3 million worth of property? So this is less used. It's a little bit more risky. Don't recommend it. Last one, I just put this slide in here because it exists. Don't do this, and we're not even going to go into it. But it's the 95% rule. You can identify $50 million worth of property. Easier example. You can identify $100 million worth of property, but you got to close on $95 million worth of it within 180 days. So it's just a rule. You have to close on 95% of what you identify. Okay, step 7. You've identified, it's been within the 45 days. 180 days is not up yet either. You enter into the contract for the replacement property. Go through your due diligence. Your contract has to contain the assignment language. Assign the contract to the QI. Again, NABOR and FARBAR have the appropriate language, so you don't have to write anything in. You execute the assignment to the QI. And then finally, close on the replacement property. You do a direct deed, which means that the property does not, title to the property does not pass through the QI. On the relinquished, title goes from your exchanger to their buyer. On the replacement, title goes from the seller to the exchanger. So it's called direct deeding. And then any funds left over, if you trade it down, go back to the exchanger as boot and you pay taxes. Yes, ma'am.
So I have a customer who, new construction again, he has to close on his properties to exchange on the new construction, and he had to put down 20% of his own money as a deposit. How does he get that back without it being considered boot? Because his exchange is going to cover 100% of the new construction.
He doesn't. The question is, guys buying new construction, and it's going to be his replacement property, and he had to put down 20%. So he stroked a check for the 20%. The question is, there's enough exchange proceeds to cover 100% of the purchase price. How does he avoid taxes? He doesn't. He's going to have to pay, because you can't take the money out.
Well, he just had to cover the deposit, but
Right.
the exchange will cover the entire amount of the property.
Right.
He will not get that back. Isn't there language that says?
No, you cannot take, if you put the 20% down, and then you'd have the exchange proceeds go in with the QI, and then the QI takes and puts, say the QI writes a check for the 20%, puts it in, and he takes that out, that's going to be considered, you can't do that. What he should have done is put the money in, well, if he hasn't closed, he said he hadn't closed on his relinquished property yet. So he's just going to have to pay, he's going to have to either buy more property or he's going to pay taxes on the boot. So that if the numbers are exact, he's going to pay taxes on that 20% because it'll come back as gain.
Wouldn't that show as an expense?
Wouldn't it have shown as an overage? His 20% is,
No, the exchanger the exchanger is going to send in to the closing agent, to the title company, all of the money required for closing. They're not going to send all of the money that they're holding in this particular case. Some of it will go back to the taxpayer as boot. Yes, sir.
Wouldn't that be an expense to buy not in the exchange, but for his income taxes, it's expense for property. So that would be.
Well, no, the 20% down wouldn't be an expense. It'd be capital.
Investment property.
Yeah,
Yeah.
but
Never mind.
yeah, it's not wouldn't be an expense. Yes, sir.
Can the exchange property be more than one property? Like if a customer sells a property for $1 million, could they use the proceeds to buy 4 houses?
Sure. Yes. The question is, can you buy more than one replacement property? Absolutely. You could close on 20 replacement properties, depending on how much money if you sell the $1 million property and you put the money into the exchange, and then you go identify, you go buy 5 replacement properties at $200,000 a piece to use up all your exchange proceeds, that's perfectly allowable. Yeah.
What happens if the relinquished property, let's say for round numbers, is $1 million, and the exchange property that he's going to buy is $1.2 million? How is the extra 200 handled?
The question is, say the exchange property, the replacement property is $1 million, or the relinquished property is $1 million, and the replacement is $1.2 million. He brings cash to closing, or he gets a loan. Your exchanger has to bring more money into close, and that's 99% of the time. That's what happens because you want to exchange up, so you won't run into this situation where you're flipping even or down, and you put money into it. Then you're going to get taxed on what comes out.
But if someone replaces the property with a lesser value property, then taxes.
Taxes, that's the boot. That difference is the boot. That's what you're trying to avoid. Okay. Okay, who is the exchanger taxpayer? Oh, go ahead.
If I'm a tenant again, no.
Yeah.
Okay, I am the exchanger,
Okay.
and I sell my property, and I buy another, but it's not my forever home.
You're the exchanger, and you're buying another.
I'm gonna sell,
You're selling. That's the relinquished.
right, and I have the money,
Yeah.
that doesn't go, it goes to the QI.
Right.
And I now am buying my forever home on the coast of Maine. But that money,
No, you can't. When you say forever home, you mean like the one you're going to live in forever? No, that's personal property. That's not investment property. So you must replace investment property with investment property.
how do you get out of the I had some 1031s back in Maine, and they were from Boston. They buy, rent it, exchange it, so on and so forth, until they made enough money to buy the house.
You pay taxes. That's you pay taxes. Oh, so that's a great question. She's asking you what happens if you've been doing exchanges your whole life, you have this whole big pile of money, and you're ready to retire. It's what do you do? How do you get out of all the commercial property, the investment property, and get into that dream home on the beach? There are two choices. You can pay taxes, or you can die, and your kids can have the home on the beach. And literally, that's exactly what you do. That is how some of the greatest real estate families in this country have made money. They just kept flipping and flipping and flipping into bigger, better, more. They died. Your kids get a stepped-up basis. So say you start off with $10,000, you grow it to $100 million, and you never pay taxes because it was always a 1031, and then you die. Your kids get the stepped-up basis. They get the property for $100 million. And then they sell it. They keep the money because they don't pay any taxes. If it's $100 million, you're going to have estate taxes and other stuff, but just for the purpose of the example. Yes, ma'am, you're waiting. Sure, that's a good strategy. It's investment property. You have it in an LLC or whatever, and it's investment. It's rented. You take your depreciation, and then you later convert it to personal use. Now, I'm going to qualify that. When I did tax law prior to the Trump tax cut, we used to do that all the time. I do not practice tax law anymore, and I do not know if you can still do all that with the conversion and what the penalties might be. But it used to be that you could convert business property into personal property if it was not in a corporation. I don't know if you can still do that after the Tax Cut and Jobs Act. So get with a CPA. Al.
Quick question, you said that replacement property, you could do four. You could sell $1 million property, and replacement property is going to buy four,
Sure.
How do you identify property number four if you can only have a maximum of three?
Well, you have the other rules. Use the 200% rule. Identify up to 200%. So that would be an example where you would identify up. You'd use the different rule.
So it's one or the other. You could still go over three properties as long as it's still on the 200%.
Correct. Yes. Okay. Oh, sorry.
So I'm confused, maybe I didn't understand you correctly, but it sounds like if you get into a 1031 now, there's no way to get out if you can't convert it within a couple of years.
That's correct.
So you're not sure which.
You have to check with your CPA about converting investment property into personal property and what the penalties might be for that. I cannot speak to that. But, yeah, you normally would just, if you take investment property and you try to exchange it and you put it into personal property, that's not allowed. You'll pay taxes on that.
What was the rule? It was 2 years or something?
I don't know. That's a CPA question. Yes, sir.
Going back to her question, couldn't she invest in this property in Maine and have the LLC buy it and just rent it to her and just avoid all that?
I don't know the answer to that question. That's a tough one. The question is, going back to the forever property in Maine on the coast here. say she flips all of her properties into her dream home on the coast, can it be in an LLC that just rents the property back to her? I mean, there's the sham transaction doctrine. There's a lot of rules. I have a feeling the IRS would not like that. That's just my gut, though. I would do the research and see. I mean, I suppose if it was held in an irrevocable trust and it was all separate and you paid the fair market value rent and you paid taxes and the trust took depreciation, maybe. But it sounds like a lot for the dream home. I saw a question. Yes, sir. The question is, can I turn my $10 million manufacturing operation into a $10 million rental house? The answer is, it depends on what you sold. If you sold a business, or you sold, like he asked earlier, a bunch of equipment attached to that's not attached to the real estate, all of that is boot. So if you, the answer, if you sold the $10 million warehouse that you were holding as investment property that somebody else was running a manufacturing business in, and you flipped it into, you could flip that into the $10 million rental property in Port Royal. Absolutely. Like, it's not like-minded, like kind. Yeah. So, and again, I said this earlier, any U.S. real property can be flipped to any U.S. real property. So you can take the manufacturing operation that you have up north, your customer is the big shot up in Michigan and Ohio, and they're running a manufacturing operation. They sell the land, not the business. They sell the land. They can flip it into investment property here in Naples, residential rental, and as long as it's held for productive use in the trade or business for investment purposes, it meets the 1031 criteria. It does not. The character of the land is irrelevant. Okay. So this is very important. The taxpayer, the exchanger who sells the relinquished property must be the one who buys the replacement property. So if the property is in an LLC, it's got to go into the LLC. The replacement's got to go into the LLC. Now this can get confusing. I said LLC, but if the LLC is a disregarded entity, you may not have to do that. If the property is held by the husband, but you're going to put the husband and the wife, perhaps for loan qualification purposes, on the replacement, you may have to add her to the title of the relinquished before you do the sale. And then, do I have the? Yeah. So if you have a partnership, which an LLC can be a partnership, you may have, and not all of the partners want to sell, you may have to do a drop-in swap. And that basically means that the property drops out of the partnership, becomes a TIC, a tenant in common ownership with all the partners, and then those who want to sell can sell their interests, either to their partners or to a third party. Questions about this? This is important to know for when you're dealing with your customers. You want to make sure, again, that the taxpayer stays the same throughout the process. Okay, who's the QI? Anyone who's not an agent of the taxpayer can be the QI. So the employee, the attorney, the accountant, the investment banker, broker, real estate agent cannot be the QI. So if you are their realtor, you cannot hold their funds. Your broker probably won't let you anyways, but you couldn't do it under the law, you bust the exchange. So interestingly enough, you all know who I am. I have a title company, Paradise Coast Title. I have Naples Qualified Intermediaries, and I'm an attorney. Title companies that are owned by the QI can still do the closing. So if you want, you can keep it all together. If you have a title company that does intermediary services through an ancillary business, you can do that. That's allowed, specifically in the rules. And you had asked the question earlier, the smart choice, someone who knows what they're doing with insurance and a knowledge of exchanges. Okay. So what do we do as the QI? We enter into the agreement to handle the funds. We take possession of the property through the assignment, but not by deed. We transfer the property, and we make sure that the whole thing goes off, make sure the money flows without boot going to the taxpayer. That's the goal. And I won't read all these to you, but basically this is the duties and what's going on in the background. And again, we're just holding proceeds. Okay, last here, coming to the end, avoiding boot. If you transfer non-like-kind property, you're going to have boot, and taxes are due on any boot received. You'll notice in NABOR, and actually I noticed this morning in FARBAR, personal property has zero value. That's typically in there so that lenders will not assign a value to the personal property. It also happens to help with 1031 exchanges. There's no value even when the personal property transfers, so all of that money in the relinquished property can be applied to real property and be used for the exchange. And fixtures are a part of real property. Everybody knows if it's screwed or glued, it's a fixture. You all know that. And then avoiding boot. You want to purchase with equal or greater value. So you always want to trade up. If you trade down, you pay taxes. And then the other issue, I haven't mentioned this very much, but if there's debt on the relinquished property, there has to be debt on the replacement property. Yeah. So you have to reinvest the net equity, and you have to make sure that the debt on the replacement property is equal to or greater than the debt on the relinquished property. You can't pay off debt and get money out of the exchange. Okay. So you asked a couple of times, a couple of folks asked, when do they get their money back? So after the expiration of the 45 days, if you have not identified, the exchange is broken, you get your money back. If you have identified within the 45 days, say you identify 3 properties, but you use up all the money on the first property, or most of the money on the first property, you're not going to close on the other 2, you can get your money back after closing. If you identify and then don't close, I have to hold the money for 180 days. You get it on the 181st day. So it just depends. The answer is when you get the money back, it depends on the situation. But there are basically 3 options. Okay. Someone asked earlier, I said to hold their question, selling to a related party. Here are the related party rules. Basically, the relinquished property, if you sell to a cousin, or actually cousin's a bad example, you sell to a parent, a child, or a sibling, they have to hold the property for 2 years. So if they don't, they break your exchange. Yeah. Same thing on the replacement side, you have to hold it for 2 years. Okay. And then I put this in here, taxes due on final sale. These are the percentages. Yes, ma'am.
Yeah, just to go back a couple of steps, the relinquished property, if there's a mortgage on the relinquished property,
Yep.
there must be a mortgage on the replacement.
Yeah.
Okay, if you pay cash for the relinquished property, does that mean you have to pay cash for the replacement?
No. If you paid cash for the relinquished property and you have 0 debt on it, but you want to take, like that happens all the time. People want to trade you because you're generally trading up. So say that you use the 3 property rule, you sold $1 million property, you identified a $2 million property, you take your $1 million from the exchange, put that in, and then you borrow another $1 million to cover the difference. Yeah, that happens all the time.
But you cannot have a property that's a relinquished property that has a mortgage on it and take the money from that and pay cash for the other.
No. You take your $1 million, say, similar example, you have $1 million property and it's got a $500,000 mortgage on it. You sell that property and the money goes into the QI, the 500, just round numbers, forget closing expenses. The $500,000 goes into the QI and you're going to buy another $1 million property, you have to take out another $500,000 loan. You cannot bring cash into the transaction then to cover the difference. Your debt has to stay the same. Otherwise, they think you're cashing out. Yes, ma'am.
Suppose you're dealing with a case where your relinquished property is in one state and your exchange property is here in Naples. The qualified intermediary should be where?
The question is, you're selling in one state and you're bringing your money to Naples. Where should the QI be? Well, should be me, so it should be Naples. No, it doesn't matter. As a matter of fact, there are very large QI companies all over the country that will hold your funds for you, and that doesn't matter. This is federal law. It's the same across the country. There's no real variance. It's just the real issue, going back to this gentleman's question earlier, is you want somebody that's insured and experienced.
But you also want somebody that you have a contract with. I mean, if you've got somebody out in the other state, you want to make sure it's being done right.
Yes, you want somebody, but that's the professional part. You want to make sure that your exchange is done correctly. So you want somebody who knows what they're doing. Yes, ma'am. Correct. Yeah, you're basically, when you're doing, the question is, who do I need? Do I need an attorney to be on the outside if I've got you as the QI? Yeah, you need a title company to do your relinquished, and either the same or a different title company to do your replacement, and you may need an attorney in there to draft the documents because a lot of times you're dealing with commercial. Yes, ma'am. No. There's no we call it like a Chinese wall. So if you wanted me, if you wanted me to be your QI, my office could not be your attorney. So you have to make a choice. You want expert legal advice or expert QI advice? Okay. Any last questions?
If you have a seller, you don't have the exchange or anything, the buyer's coming to you as the seller, you're the seller selling the property to the exchange.
Right.
Is there anything that the seller should be aware of or watch out for? Obviously, there's going to be language on the sales contract that identifies it as a 1031 exchange. Is there anything that you need to advise your seller or the buyer to bring to your attention?
So the question is, do I need to, if I've got the listing and someone is coming to me with an offer, and the realtor, the selling agent says, hey, this is the back end of an exchange, what do I need to advise my seller about? The only thing you need to advise your seller about is they're going to be asked, and the contract is going to specify that they sign an acknowledgement of the assignment of the contract from the buyer to the QI. It doesn't cost the seller anything. They incur no legal liability. They're just going to be requested to acknowledge an assignment of contract.
Go back to the slide showing the taxes that you pay. One back there. So the capital gains tax could be 20% plus the Medicare.
Yes.
3.8%.
Yes.
9% in Illinois. So you could be paying 33 or 35% tax on a relinquished property out of Illinois. That's why a 1031 exchange in Florida makes sense.
Yeah. This is my accountant. I'm just kidding. He's not an accountant. No. Again, step one of the exchange process. Talk to your CPA. Get your customer in front of either somebody who understands 1031s, or if they have a CPA, hopefully that person knows what's going on. The biggest thing is to do the disposition analysis up front. If I'm not the QI, I can do the disposition analysis. It's just need not a lot of numbers from them. But you want to make sure that it makes sense, because you're going to pay a fee, you're going to pay closing costs, you're going to pay commissions. So you want to make sure that once all those expenses are in there, whether it's even worth it to do the exchange. And a lot of times, after closing expenses are accounted for, it's a wash. Unless they're really trading up or they've really held the property for a long time and have a really low basis. So either way, it makes, you do that. Step one is to get with your CPA and do that disposition analysis to make sure that it even makes sense to go through this process. Because again, you lose access to your funds for up to 180 days. So God forbid there's an emergency and you need money, I cannot give it to you till the 181st day unless you close on the property. Yes, ma'am.
Yeah, so if I'm counseling my buyer and he wants to buy property in Florida, he's assuming that he can do 1031 and rent it out for maybe 2 years and then he can move in and live there.
He needs to get with his CPA and make sure that that's the rule, because I do not give tax advice. Yes, ma'am. Other questions? Yes. The question is, if your seller says, I'm opening up a 1031 and you get the listing for the relinquished property, should you state so in your listing? I would put a note in the confidential information. FYI, this seller is doing a 1031. Because on the buyer is then going to acknowledge the assignment of the contract to the QI. That language again is already in the NABOR forms and the FARBAR forms. So it's not a big deal, but I would go ahead and throw that in your confidential remarks that, hey, seller's doing a 1031, buyer's going to sign an assignment.
Someone wants to do a 1031 person, and I would counsel them, not personally, but tell them to go to, do I want the interview to QI, or do I want an attorney?
Remember step one? That's so important. Do the analysis, make sure that this is even worth it up front. Okay. Do you have questions? Oh, other questions? Anybody? Thank you all very much for coming today. I appreciate it. I'll hang around for a few minutes if you have questions. Otherwise, you can call me anytime.